Okay, so this video, now let me explain this topic in your CA final paper 2 SFM, that is Strategic Financial Management. Now let me take up this topic on mergers and acquisitions. Now first you got to understand why a company should go and either take over or maybe merge with another entity. If you go to India is 103, we call this as something called the business combination. So any business combination or any takeover or any merger, makes economic sense only when the value of the combined entity is greater than the value of the two individual entities. When you simply sum it up, for example, let us say the value of company A is say $200 million, and let's say value of company B is another $200 million. So when you combine the two entities, the value should be something more than $400 million. Let us say it should be at least 450 or say $500 million. That excess value is called synergy. We combine the two entities. So now we wonder what exactly is synergy. Synergy is nothing but when you combine the two entities, there are some benefits from the merger. For example, let us say increase in market share, or let us say cost savings, that is economies of scale, or let us say there can be some tax benefits from the merger. So these benefits will increase the value of the combined entity. And that is the reason for a merger or a takeover. Now, whenever there is a takeover, there is going to be an acquiring firm and there will be a target firm. The acquiring firm, nothing but purchasing company, and target firm, nothing but the selling company. So the first task will be, you got to value the target entity so that you can decide on the purchase consideration that is payable by the acquiring firm to the shareholders of the target firm. And in shares or in cash or a mix of both. So let us take up an example to understand whether a company should go ahead and take over another entity or not. So let us go through this example that reads R Limited, and the company is taken over by A Limited. Yes, Renuka.
Yes, sir.
So let's have the question on the screen. Just read the question.
They summarize the balance sheet of our company limited as on 31st March 2010 is given below. The equity share capital 2 lakh at rupees 10 each, 20 lakh. 13% preference share capital 1 lakh. Retained earnings 4 lakh. 12% debentures 3 lakh. Current liabilities 2 lakh. In total 30 lakh. So on the asset side, you have fixed assets 19 lakh, investments 1 lakh. In current assets, you have inventories 5 lakh, debtors 4 lakh, bank 1 lakh, in all 10 lakh. So total is 30 lakh. So negotiations for takeover of R Limited results in its acquisition by A Limited. The purchase consideration consists of number 1, rupees 3 lakh and 30,000, 13% debentures of A Limited for redeeming the 12% debentures of R Limited. Number 2, Rupees 1 lakh 12% convertible preference shares in A Limited for the payment of preference share capital of R Limited. Number 3, 1 lakh 50,000 equity shares of A Limited to be issued at its current market price of rupees 15. And number 4, A Limited would meet dissolution expenses of rupees 30,000. For the breakup figures of eventual disposition of A Limited of unrequired assets and liabilities of R Limited or investments 1,25,000, debtors 3,50,000, inventories 4,25,000, and payment of current liabilities 1,90,000. Now, the project is expected to generate yearly operating CFAT of rupees 7 lakh for 6 years. It is estimated that the fixed asset of R Limited would fetch rupees 3 lakh at the end of 6th year. Now, the firm's cost of capital is 15%. As a company secretary, comment on the financial prudence of merger decision of A Limited. And the PV rate of 15% is also given.
Okay, even the discount factor at 15% given to you. And so in this example, you have been asked to decide whether this company, that is A Limited, should go ahead and purchase R Limited. That is a question. Now, given the cash flow after taxation, CFAT, and the discount rate at 15%, you can go ahead and calculate the present value of all the future economic benefits from the acquisition. Now, once you calculate that, you can go ahead and calculate what is the net present value of this particular takeover or the merger decision. Now, how do you go about this example? Let me set the context first. So, the first step will be, you got to calculate now what is the cost of acquisition. Now, if you notice at time 0, what are the cash inflows and cash outflows? Now, it is very clearly given that A Limited is a purchasing company and R is a selling company, and A takes over R Limited. But some of the assets appearing on the balance sheet of R Limited is not wanted or required by A Limited, and those assets are disposed of. Now, if you notice in the question, it's very clearly given that some of the assets have been disposed of. That is, investments have been sold for X amount, and then inventory is sold for Y amount, and debtors are sold or realized for, say, Z amount. So the amounts are given out there. Agreed. And then they're given the payments made by the purchasing company. That is the payment to debenture holders. You have the payment to preferred shareholders, or say preferred stockholders, and then you have the payment to equity shareholders. And all these are payments. And then you got to list down all the payments, even payment of current liabilities given. So you got to calculate the cost of acquisition, the first step. And once you calculate that part, that is one piece of the solution. And then you got to calculate the present value of all the cash inflows from the business. And then you have you can find the net present value, which is a PV of all your cash inflows minus the initial outlay, the cost of acquisition, and you get a net present value. And once you get a positive NPV, you can go ahead and buy the other business. In case you get a negative net present value, then you can advise A Limited not to buy R Limited. Right? That is the layout of the solution. Now let me get deeper into determining the cost of acquisition. Now, people might say that, sir, rupees 3,13,000 paid to debenture holders is not a cash outflow. But I will say it's a cash outflow. You know why? Because when I issue rupees 3,30,000 worth of debentures to pay the debenture holders, I am accepting a responsibility to pay interest on this 3,30,000 rupees for the next whatever number of years this business will last. As for the question, it won't last for how many years? I think 6 years. At the end of the 6th year, I have to repay the principal in case I decide to liquidate this particular business. So, the 3,30,000 rupees debentures issued as a consideration might look like a non-cash consideration, but it is not so, because by issuing a debenture worth rupees 3,30,000, the 3,30,000 can be understood or construed as the present value of all the future cash outflows, rupees 3,30,000. Similarly, the amount of rupees, how much is paid to the preference shareholders, Renuka? How much is paid to the preference shareholders as a part of consideration given just after 3,30,000?
Yeah, it's
what is the amount?
1 lakh for 12% preference shares.
Preference shares are issued, is also a cash outflow, because the minute you go to issue rupees 1 lakh worth of preference shares, you have to pay dividend on these preference shares for the next 6 years, and also repay rupees 1 lakh to the preference shareholders. People might argue that it's a convertible preference share. That doesn't matter. You convert it to equity share. And when you're going to close down the business after 6 years, you have to repay them anyway, because they'll turn into equity shares and you have to pay them anyway. So therefore, even that's a cash outflow. And even the 1,50,000 equity shares issued as a part of consideration, valued at rupees 15 each. Even that will be taken as a part of, it's a cash outflow. It will be under the cash outflow because, you have an obligation. People might say, sir, we don't have an obligation to pay dividends. No. What happens? You may not have a contractual obligation to pay dividends on equity shares, but in order to keep the equity shareholders happy, you have to pay them some dividends. So you want to pay dividends because there's always a KE, cost of equity. There is no free lunch, a very popular phrase. So you have to pay dividends on equity shares just to keep the shareholders happy. And also you have to repay the equity shareholders at the end of the 6th year, when the company, this particular business is liquidated. So now, let us look at the solution. Now, if you check the solution, the first step will be calculating the cost of acquisition. And when I say cost of acquisition, don't think of Ind AS 103 and say only payment to equity holders, or we say the holders of equity instrument is a part of consideration. They are all cash outflows. You got to now say, whenever it's financial management, think of cash inflows and cash outflows in those terms. Now we'll go through the cost of acquisition. The first step will be, first we'll try to put all the inflows that's going to come in at time 0. That is a sale of unrequired assets. You have the sale of investments, you have the sale of inventory, you have the sale of debtors. And apart from these 3 items, you got to consider even the cash on the balance sheet of our limited. Please remember this. The cash available on the balance sheet of the selling company or the target company belongs to the purchasing company once they buy the business. Therefore, even the cash available on the balance sheet will be taken. Apart from sale of investments, inventory, debtors, consider cash. That is the total of all the cash inflows. Then you have a list of payments. The payments are, you have payment to debenture holders, 3,30,000, payment to the holders of preferred stock or preference shares, and payment to equity shareholders, and then also dissolution expenses And we have one more item, payment of current liabilities. Now, what are you going to add up all the payments? And then you can reduce the cash inflows and you find the net cost of acquisition. And that works out to rupees 90 lakh. And once you get this 19 lakh, that is the cost of acquisition, that is your net cost at time zero. Then the next step will be, you got to prepare a table. It's 4 columns. We have the year, we have the CFAT, you have the discount factor at 15%, and you have the present value. Now, people might wonder what exactly is this 15% cost of funding. And you should all know one thing. This 15% is nothing but the cost of funding. That is the cost of capital, which will include the cost of the equity and then the cost of debt, debentures, and the cost of preference share capital, and all weighted, by the proportion. And this is your weighted average cost of capital. We say WACC, or you can say that is your WACC. Okay, if you want to put it in a very stylized manner. So it is going to be, use 15% as a discount rate for discounting these cash flows. And everybody should understand this is a CFAT given out here is nothing but your operating cash flows after taxation. That is before adjusting for any interest or dividends. The reason is the interest and dividend, the cost of debentures as interest, and the cost of preference and equity, the dividends, all captured in that 15% discount rate. No double counting. So now we put down the years 1, 2, 3, 4, 5, 6. And then I have, the cash flows listed for each year. What is the cash flow each year, Renuka? It's going to be rupees 7 lakh.
It's 7 lakh each year till 5 years, and in the 6th year it is 10 lakh.
Rupees 7 lakh of each year, let's see, for the first 6 years. And in the 6th year, you have one more cash inflow. It's given that you want when you sell the fixed asset at the end of year 6, you will earn another 3 lakh rupees. So adding both is going to be 10 lakh for the last year. Then you place a discount factor at 15%. And the discount factor is given. Okay, you can divide 1 by 1 plus I. And you have the discount factors given. And multiply the discount factor with the value 7 lakh rupees into 0.87. You will get the amount present value. What is the amount for the first year? 7 lakh into 0.870?
6 lakh 9,000.
What is the meaning of this? Let me tell you. You earning rupees 7 lakh at the end of year 1 is as good as earning rupees 6 lakh and 9,000 as of today, and investing that money for 1 year at 15% rate of interest. Is that it? And that is understand. The present value 6 lakh 9,000 represents earning rupees 7 lakh after 1 year is as good as earning 6 lakh and 9,000 rupees as of today, and investing that money at 15% for 1 year. And then the second year, if you notice, 7 lakh rupees into 0.756. How much you get? It works out to
5,29,200.
What is the meaning? You earning rupees 7 lakh after 2 years is as good as earning 5 lakh and odd, today, and investing that money at 15% for 2 years. It allows the money to compound. And that is supposed to be the wonder. One of the wonders, that is compounding. If you let your money grow, that will do a better job than the people, right? So then the money will grow over time. And you have the 3rd year cash inflow, 4th year, 5th year, and 6th year 10 lakh rupees into the 6th year, 10 lakh rupees into the 6th year factor. And then finally you get the total of the PV of all the cash inflows from the business works out to rupees how much?
27 lakhs 78,400.
Now that is the PV of cash inflows. From that you subtract the initial outlay, that is your net cost of acquisition, which is rupees 19 lakh. And if you net off, you get a positive net present value. And therefore, you should go ahead and please embrace. Okay, please go ahead and get married to R Limited. That is the advice given to A Limited. They should go ahead with the marriage and go take over, okay, R Limited. It is worth a takeover because you have a positive net present value. Therefore, the benefits exceed the cost. There is a net benefit of rupees 8 lakh and odd. Therefore, you should go ahead and take on, or rather, go ahead and take over R Limited. Right? And that is the end of this video. And let me take up a complex example in the next video. Okay. Bye-bye.